Hi, Dr. Patrick Gentempo here, and thank you for joining us on our YouTube channel. We have great content in store for you. I'm so excited to be here with you, and let's jump right into it. I've been looking forward to this conversation, so thanks so much for taking the time.
Thanks so much for having me. It's really good to be with you guys.
Well, you've written some great books, and certainly you have some great references. But let's talk about your background. Like, what was your trajectory like? How'd you get to be doing what you're doing right now?
Well, so I grew up in Salt Lake City, Utah. Good Mormon boy. Spent 2 years getting rejected in French in Paris. As a Mormon missionary. Then I spent a couple of years at the University of Utah, where I did my bachelor's in accounting, and another couple of years at the University of Texas to get my master's of accounting and tax. I spent 7 years with Ernst & Young, one of the largest CPA firms in the world, including 3 years in their national tax office. Spent 4 years as the in-house tax advisor for a Fortune 1000 company. Spent 14 years as an adjunct professor in the Masters of Tax program at Arizona State University. Spent 25 years buying, building, selling CPA firms. Last 15 years, spent a lot of time traveling the world with Mr. Kiyosaki of Rich Dad Poor Dad fame. And for the last few years, been building a network of CPA and financial services firms around the country. We have about 60 in our network now.
Wow. Joey, I guess you're doing a lot of things concurrently. Otherwise, you'd be about 140 years old.
Yeah, I look good for my age, don't I?
Yeah, you look really good. You're doing something right. So now let me ask, you have, because of your relationship with Robert Kiyosaki, who was in this series, incidentally, obviously you have great expertise around the world of real estate and, how you can have, I guess, what you call it, legal tax avoidance. I don't know what the right characterization is, through real estate and real estate investment, et cetera. But we're here more to talk about crypto and, and what the environment is around this, which is kind of, I think there's a lot of speculation, and then maybe there's some things that are known. So what do you know about crypto, and how do you see it?
I do own crypto, so I know that much. I know how to buy it. I can buy and sell it. Crypto is an interesting animal because it in a lot of ways, it functions like a precious metal, like gold or silver from a financial standpoint. From a tax standpoint, it's actually considered property. It's not considered a stock. It's not an option. It's not a currency. It's got its own little world, but then it's not. So we really don't have a lot of guidance. I think in the US for sure, and really I don't think any country has given much guidance on how to tax it. I do know that the government, they're very interested in tracking it. And I think that's their big interest right now. And then they'll figure out how to tax it once they figure out how to track it.
So what is the current circumstance? So let's say I'm a person, I own crypto, I bought it some time ago. It has gained quite a bit in value. And I have to imagine that if I don't trade it back for cash, but if I'm just holding my positions, there's no taxable aspect to that, I'm assuming, right?
Right. In the US, like most countries, we don't tax currently. Now that is actually suggested as a change, but currently we don't tax a gain or tax a loss, frankly, realize a loss until we actually make an exchange. So we either have to sell it or exchange it to recognize that gain or loss.
Now, you said it's kind of held as or looked at from a tax perspective through the lens of the tax man. It's property, right? But now, if I were today to sell some of my holdings and realize a profit, would I be reporting that and being taxed on it?
Yeah, you would. The easiest, the closest thing it is like stock. Okay, it's probably closer to stock than anything from a tax standpoint. So if you hold it for more than a year, it's going to be a long-term capital gain. If you hold it less than a year, it's going to be short-term capital gain. The unusual thing about crypto versus stock is you don't usually go buy something with stock, and you can do that with crypto. And the most important thing I think for people to remember is that anytime they use crypto, they're selling crypto. So any of those transactions, those are taxable. And even some of the credit card transactions are taxable every time you use it. So it's going to be quite an interesting tracking rule to come out of this.
Well, yeah, this is where it gets interesting because obviously people are looking for tax avoidance, right? Now they start to play games, if you will. So let's say that I have an offshore crypto account, and it's got whatever value it has, and I decide to go buy something out of that account. I have to imagine, or correct me if I'm wrong, that's still reportable as compared to saying I just leave it offshore, don't repatriate it, try to avoid the tax that way.
The U.S. is a little different when it comes to its citizens and full-time residents, because it says the U.S. says doesn't matter where that gain is realized, you're going to be taxed in the U.S. So just because it's offshore, corporations can set things up offshore to do what you are suggesting, until they repatriate it, or they used to be able to prior to 2017. But individuals, we don't get to do that. And so anytime we use it offshore, it's going to be taxable.
So now I have observed that there's this burgeoning crypto community showing up in Puerto Rico. So, and I think they're there for tax avoidance. What do you know about this?
Well, I think that's pretty much the only reason to be there, right? It's tax avoidance, unless you just really like, hurricanes and power outages.
And earthquakes.
And don't get me wrong. I know a lot of people in Puerto Rico, but it is tax avoidance. It's really, Puerto Rico has an agreement with the federal government that if you live there full time, basically 6 months and a day out of the year, just like, whatever your state residence is, you have to be there 6 months a day. Same thing for Puerto Rico. If you live there full time, then your capital gains your capital gains aren't taxed, okay, or they tax at a lower rate. Even your ordinary income can be taxed at a lower rate if it's service income. In other words, if it's something that you're doing for people in the United States, you're doing it from Puerto Rico, you're going to get this low 4% tax in Puerto Rico. So there are some really good tax benefits that are completely legitimate. They're an incentive. Remember, all tax benefits, legal but tax benefits are incentives, right? They're incentives to do something the government would like you to do. And one thing they'd like you to do is, if you're rich, they want you to move to Puerto Rico because Puerto Rico needs the capital, they need the people, they need the population. So this is an effort to build up Puerto Rico on behalf of the United States.
Let me ask this. Let's say that a person goes down there and they're there for years and they're in full compliance and paying that 4% all-in tax, and they accumulate whatever wealth they accumulate there, and then they decide to move back into the mainland, to the United States. Are they going to be taxed on whatever wealth they bring in, or it's considered it's already been paid? And
they're not. It's taxed. So they'd still be subject to a wealth tax or an estate tax. Okay. If we get this capital gains tax on death, we have no idea how that would apply. But the estate tax would presumably still apply. To my knowledge, there's no estate tax exclusion in Puerto Rico. So it's just the income tax, capital gains tax that you're going to avoid, but you can avoid it permanently. Yeah.
Oh, wow. Okay. That's interesting and good to know. You said something about, you need to be there 6 months and a day. I won't mention any names, but I have a, extremely billionaire friend of mine, wealthy guy, who has multiple residences. But he claims primary residency in Florida. And, I said, oh, so are you in Florida over half the year? He said, no, I just have to be in Florida more than I'm in any other place. Is that accurate?
Well, that's an interesting question, because there's a question, and I don't know the answer because I'm not his tax advisor, right? I mean, I don't know all of the ins and outs of this. It can get a little complex in the details. But the one issue that you have is not having a tax home. So you actually want to have a tax home. Let me give you an example. Let's say you're traveling away from home on business. If you don't have a tax home, that travel's not deductible because you're not away from home because you have no home. Okay, so there are some downsides to that argument, because if you could the IRS has won this in court a number of times over the years. Typically it was historically it was a traveling salesperson, and they said you didn't have a tax home, so your travel wasn't deductible because the travel is only deductible when you're away from home and you have no home. So there are some intricacies there. I don't know his particular situation. The general rule in Puerto Rico, it's very clear. It's 6 months in a day. Okay, you don't get to do more in Puerto Rico than anywhere else. That doesn't work there. That's a very specific test.
Yeah.
Florida, I would have to look at their rules to see what the requirements are.
Thanks so much for being here and watching that video. And can I ask you to please subscribe to our channel so you can find out when we're posting new content. You'll be alerted right away when we do. To share this with people you think might benefit from the information, and certainly it helps us if you like the video. So if you like what you just saw, go ahead and hit that like button. And again, thank you so much for being here with me right now.